What if I told you there is a bond ETF sitting quietly on the market right now, on this 3rd of July 2026, yielding around 8% per year, and its entire business model is essentially betting that a major hurricane does not flatten Florida, or that a catastrophic earthquake does not level Tokyo? Most income investors are staring at government gilts paying 4% or dividend stocks with yields barely scraping 3.5%. Completely unaware that an entirely different corner of the fixed income world has been quietly compounding at double those rates. This asset class is called catastrophe bonds, or cat bonds for short, and the ETF structure wrapping them is now accessible to ordinary retail investors. Today we are going to pull back the curtain on exactly how this works, what the real risks are, and why the financial press has only just started paying attention. A catastrophe bond is a type of insurance-linked security, or ILS, first developed in the mid-1990s after Hurricane Andrew devastated the U.S. insurance industry in 1992 and exposed just how inadequately capitalized many insurers actually were. Here is the mechanics: a major insurer or reinsurer, think Swiss Re, Munich Re, or a large national government, needs to offload the financial risk of a specific catastrophic event. Rather than buying traditional reinsurance from another insurer, they issue a bond to capital market investors. You, the investor, buy that bond and receive an attractive coupon payment. In today's market, that might be 7 to 9% annually. In exchange, if the defined catastrophic trigger event occurs, say, a Category 5 hurricane making landfall in a specific zone, or an earthquake exceeding a certain magnitude, you can lose part or all of your principal. If the disaster does not happen within the bond's term, typically 3 to 5 years, you get your money back in full plus all those juicy coupon payments. It is, in the most literal sense, insurance capital coming from the bond market rather than from other insurance companies. For most of their history, catastrophe bonds were strictly the domain of institutional investors, pension funds, hedge funds, and specialist ILS managers. Individual minimum investments were routinely in the millions of pounds or dollars. That changed when asset managers began wrapping diversified baskets of cat bonds into exchange-traded fund structures. The ETF holds a portfolio of dozens of individual catastrophe bonds, each tied to different perils in different geographies, so one bond covers Atlantic hurricane risk, another covers California earthquake risk, another covers European windstorm risk, and so on. This diversification across perils and regions is critical, because any single bond carries the risk of total loss. Spread across 30 or 40 bonds, the portfolio's worst-case scenario is dramatically less severe, because it would take multiple simultaneous global catastrophes to wipe out the entire fund. Investors can now buy and sell shares of this ETF on a major stock exchange just like they would purchase a share in a FTSE 100 tracker, with no minimum investment beyond one share price and full daily liquidity. The 8% yield this ETF is offering today, as of early July 2026, is not a gimmick or a sign of distress. It reflects what the catastrophe bond market is actually pricing risk at right now. Several factors have pushed cat bond yields up significantly over the past 3 years. First, a string of costly natural disaster years, particularly the active Atlantic hurricane seasons of 2023 and 2024, reminded reinsurers exactly how exposed they are, prompting them to issue new bonds with higher coupons to attract capital. Second, the broader reinsurance market has experienced significant capacity withdrawals, with traditional reinsurers pulling back from certain catastrophe-exposed lines, which drives up the price they must pay to transfer risk via cat bonds. Third, the base rate environment has also helped. Cat bond coupons are typically structured as a spread over a floating rate benchmark, meaning as central bank rates rose globally, the all-in yield on these bonds rose with them. The net result is that investors are currently being paid a historically attractive premium for bearing this very specific type of risk. This is the section that some YouTube finance videos conveniently gloss over, but we are not going to do that. The risk here is binary and it is serious. If the catastrophic trigger event occurs, losses can be substantial and swift. In 2017, Hurricanes Harvey, Irma, and Maria struck in rapid succession, and certain cat bond tranches suffered significant principal losses within a matter of weeks. More recently, the clustering of major loss events has led some market participants to question whether traditional catastrophe models adequately account for secondary perils, events like wildfires, floods, and severe convective storms that are individually smaller but collectively add up to enormous industry losses. Climate change is also a genuine concern. The frequency and severity of weather-related events has increased measurably over the past 2 decades, and if that trend continues, the historical loss models that cat bond pricing relies upon may be systematically underestimating future risks. There is also basis risk, the situation where a real-world disaster causes massive economic damage but fails to trigger the specific parametric or index-based trigger written into a bond's terms, meaning the issuer still collects on their bond while their underlying losses go uncompensated. None of these risks disqualify the asset class, but they are precisely why this 8% yield exists at all. The reason this ETF is making financial headlines today, on July 3, 2026, is that income investors are increasingly desperate. The traditional yield landscape remains challenging. Investment-grade corporate bonds in the UK and Europe are still offering relatively modest real returns after inflation. Meanwhile, equity dividend yields have compressed as markets have risen. Into this environment, a bond instrument offering 8% with low correlation to stock markets is genuinely remarkable. Low correlation is perhaps the most underappreciated feature here. Catastrophe bonds do not care whether the FTSE 100 is up or down, whether the Federal Reserve raises rates by a quarter point, or whether a trade war breaks out between 2 major economies. The only thing that moves their value is the probability of natural catastrophes in the covered regions, which is entirely independent of financial market cycles. For portfolio construction, that is an enormously valuable property, particularly for retirees and income investors who are trying to reduce drawdown risk. The issuers of catastrophe bonds are predominantly large, rated global reinsurers and major sovereign or quasi-sovereign entities. Swiss Re, Munich Re, Hanover Re, USAA, the World Bank's International Finance Facility, and various national flood insurance programs have all been active issuers. The bonds themselves are typically structured through special-purpose vehicles domiciled in the Cayman Islands or Bermuda, which hold the investor proceeds in highly rated collateral, usually U.S. Treasury money market funds, for the duration of the bond. This collateral structure is important. It means investors are not taking credit risk on the insurer itself. Even if Swiss Re went bankrupt tomorrow, the collateral backing the cat bonds sits in a ring-fenced special-purpose vehicle entirely outside Swiss Re's balance sheet. What investors are exposed to is purely and solely the catastrophe risk the bond was designed to transfer. That structural clarity is one reason institutional investors have warmed to the asset class over the past 3 decades. Looking ahead through the remainder of 2026, the catastrophe bond market appears positioned to remain an attractive income source for those willing to do their homework. The Atlantic hurricane season runs from June through November, meaning investors who enter now are taking on peak season exposure. That is a fact worth noting. However, the current spread levels suggest the market is pricing that risk fairly. The total outstanding cat bond market has grown to roughly $45 to $50 billion globally, a figure that has more than doubled over the past decade as both issuers and investors have recognized the mutual benefit of this capital market mechanism. Asset managers including Brookfield, Amundi, and various specialist ILS boutiques are actively expanding their retail-accessible cat bond products precisely because demand from income-seeking retail investors has grown sharply. If the 2026 Atlantic hurricane season passes without a major loss event, as many forecast models currently suggest, though no forecast is certain, spreads may tighten modestly, but existing bondholders will have earned their full coupon. The longer-term structural case, driven by climate risk, reinsurance capacity gaps, and investor demand for uncorrelated income, appears durable. Here is the clear and honest takeaway. A catastrophe bond ETF paying 8% is a genuinely legitimate, institutionally respected asset class that happens to be underrepresented in most retail investors' portfolios, not because it is obscure or exotic in any suspicious way, but simply because it has not historically been accessible to non-institutional buyers. The 8% yield is real, but so is the tail risk. This is not a replacement for a diversified core bond allocation. It is, however, a compelling satellite allocation, the sort of position that might represent 5 to 10% of an income-focused portfolio, adding meaningful yield and genuine diversification without exposing you to more equity market risk. Do your own research, read the fund's prospectus carefully, understand specifically which perils and geographies the bonds in the ETF are exposed to, and consider whether your personal risk tolerance accommodates the possibility of a loss year if a major catastrophe cluster occurs. If it does, this is one of the most genuinely interesting income opportunities available to UK retail investors right now, one that most of your peers have simply never come across.